right, Lobo. Last time we spoke, we ended sort of on a note that it's common wisdom, if you will, out there that you sell on the news that a company is preparing a maiden resource estimate, an MRE, if you will, and you didn't quite agree with the pleb wisdom that it is. So let's maybe take it from there. Where are we now on the Lassonde curve? What is the risk reward? Just generally, what's going on?
Right. Well, the MRE is that first peak in the Lassonde curve, presumably the capping of the discovery phase. There's a couple reasons why I wouldn't automatically or I wouldn't set that as an exit point. I would look at a case by case basis. There's primarily sometimes an initial MRE is really that. I mean, it's not the resource. It's not even close to what it's going to be. It's just we've got all this drilling. We need inputting our hands around what this might be, and we put an initial number out. And you can tell when that's the case, because if they start running into the edges of the system, even if they don't say so, but you see that the holes on the edges are starting to be thinner or lower grade or something, you get the feeling that, okay, we're this is it. This is what it is. Whereas if we're going to put out an initial resource estimate just because we've been drilling a couple of years and it's still wide open, we still have no idea how big this thing might be. Or, we're drilling systematically, but we did a wildcat hole a kilometer down trend or half a mile up strike, and it's still there, or at least some similar mineralization is still there. There's a pretty good reason to think that this could be much bigger than the initial estimate suggests. So I definitely wouldn't automatically sell on that. And the other thing is looking at the specifics. There's times when every headline of the press releases along that initial discovery phase, the success and progress phase that we talked about before, every headline has these high-grade hits, even thick high-grade hits. Wow, 10 meters of 15 grams or an ounce per ton or something, fantastic results. But then if you look at the rest of the holes in the release, they'll always highlight the best hole. Nothing wrong with that. Nothing dishonest about that, saying our best result is. But you need to make your decisions not based on the headline. You need to make your decisions based on what's the average. What are all the holes looking like overall? And if for every one of those high-grade hits, there's a half a dozen or more that are low-grade or narrow or both, that headline is not going to be anywhere near representative of what the overall deposit looks like. An example of this would be Walbridge mining, which, I don't normally do, specific company analysis on interviews for free, but it's just such a great example of what we're talking about. They have a significant deposit. I'm not saying Walbridge is the worst thing ever. What I am saying, though, is it was a classic case of every headline had spectacular high-grade numbers, even in the hundreds of grams per ton of gold, not silver. But the overall average was much, much lower than that. And I could tell before they did their initial resource, it was going to be nothing like people seemed to be imagining. When people were giving the company $1 billion before they had a resource estimate and valuation, and it was clear that the deposit was not going to be anywhere near as high grade as the headline suggests, and probably not as big as the overall mineral footprint suggested. Plus, the geology was very complicated. I actually own that stock. You can look at my public track record of all closed deals. It's a fully transparent track record with screenshots of my brokerage trades and everything. You see, but I paid in fees, everything. So I own that stock, and I give this as an example. I could see what was coming in the mineral resource estimate. I was sure, or reasonably sure, that thing was going to disappoint a lot of people who had bought based on the headlines. But the opposite can be true too. I'm not sure that I have a clear example off the top of my head, but there's times where, okay, I can think of one. North Bullfrog back in the early Corvus days, before they shifted to Mother Lode and then got taken over and all that stuff. Company doesn't even exist anymore, so it's easy for me to talk about Corvus. But North Bullfrog had it had intercepts. They were neither very broad, it wasn't hundreds of meters of bulk grade mineralization, and they weren't narrow high grade. It wasn't, meters or tens of meters of very high grade mineral. It was in between. It was like 10, 20, 30 meters of bulk grade, and so it wasn't clear that this thing was going to be big or good. But it was over a very large footprint. like to me, it's huge. And even though Mr. Market could clearly understand narrow high grade, okay, I get it, or huge bulk tonnage, okay, I get it. It was something in between that the market couldn't seem to get its arms around. But I thought it was going to be bigger and higher grade for open pit mining than the market appreciated. And then they came out with, I don't remember, it was like 1.4 million ounces of good, bulk grade mineralization. And then they did start finding some higher grade stuff that got people all excited. And then other things happened. They went in another direction. I'm not saying that, yay, me, I got everything right about that company. I got distracted. In fact, I did buy it later, but not because of this. I bought it because of a completely different thing when they became a takeover target. But the point of the story is, from the MRE, I thought that MRE was going to surprise to the upside. I thought they were going to deliver more value than the market was expecting, and the stock could easily pop on the MRE. And so if you have a case like that, you don't want to sell in front of that. You want to use the MRE itself as your liquidity event, or at least hold on to that to see if you're right and if the market is surprised by how much value the company has drilled off. So definitely one size doesn't fit all. Definitely wouldn't have a blanket policy to sell on the initial resource estimate, but definitely would want to if I thought the story had gotten ahead of itself or was overhyped. And then we go into the boring engineering phase after that, and a whole different set of questions.
Right, but you have to. It sounds to me like you have to have, specific knowledge to understand what to do at that MRE stage, and it's mostly geological knowledge. So, what do you? I guess two questions here. So, in your experience, do MREs tend to disappoint just overall? Like, can you say 70% of MREs or something like that disappoint? Because that could be a fast rule.
Yeah, no, I couldn't put a number on it. At a wild guess, I'd just say maybe 50-50. It's okay. A toss of the coin. I mean, there's a good number that's surprised to the upside. It's not an everyday occurrence, but it's fairly common that you'll see a press release that somebody comes out with X, Y, or Z initial resource estimate. And wow, that's more than I thought, right? It's clearly more than Mr. Market expected it. I think that's as common as, a disappointing initial resource estimate. And I don't think you have to be a PhD geologist to see that coming. I'm not even, a BA or a BS in geology. I don't have a geology degree. I just play a geologist on TV. But when there's a lot of hype, there's a lot of promotion, when there's a large discrepancy between the headlines and the averages, and yes, you do need to do a little bit of work here. Due diligence is not optional in resource speculation. You need to read the press release. You need to look for the table of results, not just the headline. And this isn't hard. It's not rocket science or even rock science. But look at, as our esteemed guru Jerome Powell likes to say, look at the totality of the data, not just the headline. I mean, this is obvious, but people are lazy. All you have to do is not be lazy, and you're already 80-20 rule ahead of the investment herd.
Well, what do I have to do? So you said look at the, what specifically am I looking at, and what am I looking for?
You're looking for a sense of the average grade and thickness of the overall results. How many of them are these high grade hits or these hundreds of meters of good bulk grade hits versus, more chopped up stuff or lower grade stuff. If most of the holes are similar to the high grade headline or the big headline, then that's encouraging. If most of them are very different from that, then that's discouraging. It's not necessarily a deal killer. I mean, there obviously, if you are a PhD in geology or if you're a resource engineer, then you can do this much better than I can. But investors should not just give up and say, "Oh, that's beyond me." I mean, it should be obvious enough to anybody if none of the rest of the resource drill holes are like the headlines. That's clearly bad news. And if, let's say, it's a bulk target, and within that there's a vein that has high grade hits, and that's why the majority of the results are bulk, and there's a minority that's high grade. There's a reason for it. That's okay. If that vein is consistent and it's a high grade sweetener within the overall deposit, that makes sense. But management should say that. It shouldn't sound like the whole deposit's going to be like the super high grade hit. The press release should be honest. It should say, look, our average is whatever. But within that, we have this high grade domain. We think it's consistent. We think it'll enrich the overall result. That's fine. Again, you really don't have to be a rock science or scientist to do this, but you do need to pay attention and read enough into the press release to have a sense for what the averages are.
So it's grade variability that I'm looking at, for example. So if I see a resource
grade and thickness,
right?
And that's not necessarily grade times thickness, because if you have one intercept that's 1 meter of 10 grams and you have another intercept that's 10 meters of 1 grams, your grade thickness is going to be the same.
Right.
But mineralization is obviously completely different. So yeah, I will. You could even do it in chunks. Like, look at the average widths, just the widths. Forget the grade for a second. Just look at the widths. And if you've got 100 meters here, 1 meter here, there's something going on there that's kind of crazy. At the very least, the geology is complicated, which is at best a mixed blood. Can make for more mineralizing fluids to flow through the rocks, but it also makes it harder to mine or define even the resource. And then you can go back and look at the grade. Okay, if the thicknesses are consistent, but the grades are highly variable, well, that's not great. If the thicknesses are variable, but the grades are highly consistent, well, the geometry with a good mine plan. If both are highly variable, then that's a clear warning. Not necessarily a fatal flaw, but it's a clear warning. This is complicated. This won't be easy to figure out or to mine. And it needs to be the overall resource needs to be pretty compelling.
So I've been doing that as of lately, maybe over the last year or so. And when I see half a gram of gold, and then on the other intercept is like 12 grams of gold, I would not necessarily discard the company, but I would reach out to them and ask them for an explanation about, hey, are you thinking about the variability? How are you thinking? But now I'm starting to think that maybe I'm too naive, and a CEO might BS their way around it, because they can explain something to me that I don't quite understand, but still sort of convince me that it's okay. So I don't have a question, but that's what's happening.
But that you're even asking the question and reaching out to the CEO is more than most investors will do. So don't beat yourself up too much. But yeah, I guess I would say don't let yourself be too convinced either. And I'm not saying they're all liars, but it's their job to put the best possible light on whatever it is they're doing. Even the most serially successful ones, your Ross Beatties and Bob Quartermains, or whoever these people are, your Robert Friedlands. And even these people who have found and continue to find deposit after deposit, they never tell you, oh yeah, this first round of drilling really sucked. They never say that. They'll say, oh, this was instructive, or maybe this will help us vector in on better mineralization in the future, or whatever. That's their job. So you can't blame them for doing that. It is your job to understand that you're on the opposite side of the table, and you have to be skeptical of everything they say. That doesn't mean they're liars. That means that's the roles you have to understand you're in. My mantra on this is assume bullshit and you'll never be disappointed.
That's right. Yeah. But then you also might stay on the sidelines a whole lot more often.
That's fine. As Doug Casey taught us decades ago, you can't kiss all the girls and you only get black eyes if you try.
It's true. So that's variability. That's actually a good start, because it can be structured that way. So grade and thickness variability and grade thickness variability. Then there's something else that I also recently just started looking at, and that's continuity. Like how are the grades split, and is it at the beginning of the hole and then not a whole lot of nothing and then a little bit at the end? So how is that? How do you look at continuity?
Well, that's a good question, and not one size fits all. It can be instructive if you have a bulk grade target and the continuity is not great, but the overall, like, you're going to put this whole thing in a giant open pit anyway. You're going to be mining all that stuff anyway. And let's say it averages a gram per ton over 100 meters. Great. There's a lot of gold there, right? Or 100 grams per ton over 100 meters of silver. Great. There's a lot of silver there. Fine. But if the reality is that it's not a 100-meter interval of equally mineralized, I'm redundant there, but equally mineralized rock, but it's actually a bunch of discrete layers. It's a meter of 100 grams here, and it's a half a meter of 500 grams there, and it's 10 meters of 20 grams there, and it all averages out to 100 meters of a gram per ton gold, or 100 silver, whichever example you like. If you're going to mine it all anyway, that's fine. It doesn't matter. You're taking all that rock. If you're looking at veins, though, and you have to mine these things, then that's a huge potential problem, because this one might be economic, the one right next to it might not. If you have to skip that one to mine the next one, then you've got barren development there. It's going to increase your expense from getting to one to the other. The average number could look considerably deceiving if you don't look at the sub intervals there. So it depends on exactly what you're looking for. It also, I don't know how far we want to go down this rabbit hole, but sometimes there are discrete layers within an overall deposit, and they actually can be mined separately, even on a bulk basis. Like you model this as ore, you model this as waste, you model this as ore, this is waste. When you get to the waste, you just send that to the waste pile. You don't put it on the leach pad. And they're discrete enough. Like, instead of being lots of little intervals that average out to this, you'll have a few broader intervals or layers of rock. This one host rock is mineralized, this one isn't, blah blah blah. Then you can selectively mine those, and so that matters. And in terms of how the resource is done in the end, you wouldn't basically be mining the whole pit. You would be mining slices of it, and that matters to what your average grade is going to work out to be. I'm not sure how far else you want to go in there, but continuity it's tricky. It's important. It would be great if you had very, but it's rare. Most veins, as we say, pinch and swell, right? It's narrower here, thicker there, and your average grade and thickness, gives you an idea for the economics. But the reality, when you mine it, is going to be, you need to know how it pinches and swells. You don't want to be taking all the surrounding barren rock when you get to a narrower area. If you can, you want to mine just the narrow bits. So that's something to watch for, but that's normal. When you have something that's consistently, thick and highly mineralized, I could give some examples, but I won't right now because they're active plays in the market today. I'm not thinking of a historic one. Oh, maybe, yeah. The Eleonore discovery in Quebec, that the original Virginia Gold had, and then got taken over, and Goldcorp put it into production, and now that's gone too. So twice gone story, not giving anything away. But every time they drill that bad boy, it was like 3 or 4 meters of 10 to 15 grams, 20 grams. Like, it was very consistent. So it turned out in the end, when they built the mine, to be a little more complicated than they understood from the initial drilling. But as we were going through that success and progress of drilling off the discovery, it was highly consistent. So however it worked out in the end, you knew that there was a lot of gold there, and it had the characteristics that could make for a mine. And it is a mine today. So that was true. There were complications along the way, but it was true. But where I'm going with this is, it was consistently high grade. It was consistent in its thickness, of mineable thickness, and that got taken over. It didn't just produce a surprisingly good resource estimate. That company got bought out before it even managed to produce a resource estimate. That was striking. That doesn't happen often, but the results were so consistent that a larger company came and bought Virginia Gold, lock, stock, and barrel. Well, they spun out some other resources in the end, but the company got taken over for this discovery before they even reached a resource estimate, because of how consistent it was. So that's how important good consistency can be.
You make a very good point. I'll go back to what you were just saying, but this is a very good point, that it doesn't happen often. The companies, a grade bear gets bought pre-resource. But every CEO, when you ask them when's the resource coming out, they're going to tell you, well, maybe it's not coming out. Maybe we're going to get bought. And I'm like, but it like almost never happens. So is that really a viable plan? But it is something that, if you're inexperienced, a CEO will tell you, and you're going to be like, oh, wow, so this must be special. It's nice. And so they can trick you that way, but it just does not happen often.
Oh, okay. But to be fair, and again, I'm the guy whose mantra is assume bullshit, but there are reasons for that. If you still haven't hit the edges of this system, it actually makes sense not to put out a resource estimate if you don't have to, because let's say you've got some exciting results, highly consistent over this small area, but it's just your initial target. And that comes out to say 500,000 ounces of high grade. These days, 500,000 ounces of gold is considered too small to be bothered with. I mean, when I started in this business, 500,000 ounces of high grade, that was a mine. Maybe not world class or whatever, but that was a rich mine in the making. Now, if you don't have 1,000,000 ounces plus with clear multi-million ounce potential, don't call us, we'll call you. Mr. Market doesn't care. So if you put out an initial resource estimate of 500,000 ounces, even if it's high grade, the market may peg you as, too small to matter.
Yeah.
And you can continue to have success. You could continue drilling and the market won't care because they've already, investors have got it in their head that it's too small. Like they don't even read your press releases anymore. Doesn't matter what they are. I mean, it would take a real shocker, some, super bonanza discovery or something that has everybody talking to get investors to reconsider things. So you don't want that. Or, let's say that you have technical problems with the drilling. You thought you could drill it at 50-meter centers or something and come up with a reasonable resource estimate. But then the engineers say, no, we really need 25-meter centers here or 30-meter centers or something. And then you got to go back and do a lot of infill drilling to come up with a defensible resource estimate. And so, it's better to do that than to put out one that's bullshit or get smacked down by the exchange as not up to standard.
That's right.
Or that the investors themselves call BS on. So there can be reasons for putting off a resource estimate. But if it keeps getting put off, and especially like I said before, if you start clearly running into the edges of the system, and you can see that in the drill results, that's the time to push really hard on management. And you either have something of merit, or if you don't, there's no clear value proposition until you have at least that resource estimate, if not a PEA.
We talked about it last time, how to sort of make your own back of the napkin resource estimate, grade by volume, by discount factor. What is too small to matter? Because Rick Rule always says that both small mines and big mines have big risks and big problems, but only big mines can make you big money. So what is big? What is small?
So that's the basis of the go big or go home conventional wisdom in the space. And there's no hard and fast rule on this. If something was high grade enough, too small might be flexible, right? If you had, so generally it's what I just said. These days, even 1,000,000 ounces or close to 1,000,000 ounces doesn't necessarily get the market's attention. It has to be over 1,000,000 ounces with district scale potential or other zones on strike that could make it multi-million ounce. If you don't have that, then that seems to be the new standard for go home. It's not big enough. That said, let's say you had 750,000 ounces, but it was at low altitude in a solid mining jurisdiction, and it was, great rock, easy to mine, and it averaged, I don't know, let's put 20 grams per ton on it. Not super bonanza, but clearly very rich, consistent, high grade. I think that would be an exception to the rule. The guys or gals running it could either build it themselves and just, forget whether the market cares or not, just make the money, just put it into production. More likely though, a major isn't going to buy an asset like that, but a mid-tier that, they're already in production, they want to make money. Their goal is to make more money. A mid-tier could easily snap up something like that and just build it, just make the money. Right. But those are rare. I mean, that doesn't happen all the time. The rule, the go big or go home rule is a pretty solid thing. Another way to look at it is not the resource endowment, but the annual mining rate. If they put out a study, PEA, PFS, or full feasibility, whatever, and they're talking less than 100,000 ounces per year, that's, less than most investors are interested in. 75 to 100 isn't bad. There are a lot of great mines that produce at that rate. Producing over 100,000 ounces a year is a pretty high bar, but you want the high bar. You can't kiss all the girls, right? So you want to set high standards. But if it's less than, say, 50,000 ounces a year, that's a no-go zone for me. I think of these as mom and pop operations, and they might work tremendously well, and they might be complete failures. Usually because they're so small, there's not enough money in it. There's not enough NPV, not enough value to justify a full feasibility study. These are the projects that often go into production without full feasibility studies, which invites all kinds of surprises, and usually very bad ones. And even if they go well, they mine it out quickly. It's a small project. It's done. The mine life is only a couple of years, and then you have to find something else to put value on. So generally speaking, it looked at by the standard of annual production. Anything less than 50,000 ounces a year is a non-starter for me personally. Anything less than 100,000 ounces a year is questionable for me as a speculator, because I don't think Mr. Market will pay much attention to it. Anything above 100,000 ounces a year, especially, if you've got 1 million ounces plus, 100,000 ounces per year for 10 years, that's a good mine life at a respectable production rate that, if not the majors, then at least the mid-tiers could be interested in.
And that's also something that I have recently again started asking about is I mean, if you're hoping to sell this thing, who could be a potential buyer in whose portfolio? And let's talk specific companies is what I say. So you can tell me, a big company can come, because what is a big company? Who is looking for this type of asset in this type of jurisdiction, yada, yada, yada. So, push back a little bit on the CEO saying, who exactly are you preparing to sell this to? And
well,
you don't often
of course they
hear
can, but it doesn't make it true. Everybody wants to sell. Yeah, well, we have this theory, and we have all these kilometers of strike. We haven't even drilled yet, undrilled. Right? Promoters love to say undrilled. It's this fantastic, wonderful thing, this potential blue sky. But undrilled means unknown. Undrilled means we know nothing about this. We have nothing here. It has zero value. Undrilled is literally nothing in terms of value. But it allows them to say that we're going to. We're hoping for this bigger buyer. It's, my main motto, my number one motto that I sign my weekly letter with is caveat emptor, the Latin for buyer beware. And we have to remember that we are on the other side of the table from these people. Even the best, most successful ones, we must not believe everything they tell us. I'm not saying they're all liars. I'm saying it's our job to question everything.
That's right.
And shame on us if we buy some positive spin without thinking it through.
Exactly. That's the good point, because a positive spin in this sort of three things that you've mentioned so far that are, in a promotional toolbox of many promoters out there, and that is underexplored or undrilled. District scale potential. I've not spoken to one CEO who's not told me that they have this. They all have hundreds of square kilometers of ground or whatever, and open in all directions. They always keep saying that, but what open could mean, barely something, and not specifically the same as what
at
you
least
would
that last one is easier to, well, they're all easy to call BS on. The first two, you just categorically say, it doesn't matter how many hectares of land you've got. It's moose pasture, it's mosquito swamp, it's whatever it is. It doesn't matter. But the last one, that's pretty specific. So if somebody says it's open in all directions, you don't have to be a rock scientist to go look at the drill sections and say, well, no, the grade's dropping off in this direction, and there's a fault on this side, and there's beep all on the other side of that fault, right? You can look at that. Now, if the company won't provide sections, if the press releases never have information you need to make an even quasi-informed decision,
That's right.
That is a reason. That alone is enough for me to not buy a stock. If they're consistently failing to provide minimal necessary information, there's no good reason for that.
Good point. That's also something that, again, you can ask about. If you think there might be a good reason for it, you can ask, but then again, you have to take your own naivete or whatever, however you say it, into account and say, okay, maybe they can trick me on this one. But I want to go back to something you previously said, because we were talking about, go big or go home, a big giant open pit. Something else that we didn't talk about is strip ratio. Strip ratio, and that's a tough one. Like, how do I even think about a strip ratio before I've seen, something on paper?
Well, it's not that tough. I mean, obviously, the higher the strip ratio, the higher the grade has to be to pay for it.
Mm-hmm.
If you can, if with today's elevated cost, this is exaggerated, but just to simplify things, let's say if you had a pit-shaped deposit, it was a triangle pointing down, exactly the same shape as an open pit, and the whole thing averaged 1 gram per ton of gold. And equivalents in other metals are tricky, but let's just go with this to simplify it. Okay, great. That looks economic. Unless you have high degrees of nasties in there, arsenic and mercury and penalizings and things like that. The average deposit like that would be a moneymaker. Okay. But let's say it wasn't this shape. Let's say the deposit was broad, but a planar feature that on one side it was laying down against the side of the pit. The other side is all waste. Like half the pit is going to be mineralized. The other half the pit is waste. So if it's 50-50, now you have 1 gram per ton of mineralization on this side. You have 0 over here. So the average is actually 0.5 grams per all tons mined, right? Now, here comes the consistency. If it's consistent, the part you're going to mine, remember I talked about selective mining? The part you're going to mine is 1 gram per ton. That's fine. You can take the 0 over here and just move it all aside. But if it's mixed, if those intermittent, inconsistent results that you were asking about before, if it's mixed throughout there, it's very hard. You might be able to model 1 gram per ton material, but the reality is if it's all mixed up with all this other stuff, you're going to end up mining the whole thing. And your actual grade, your strip ratio down to production is going to reduce your grade to 0.5 gram.
Mm-hmm.
And, that ideal scenario where you have a deposit that's roughly pit shaped, I've only seen one in my career. In 20 years, I've only seen one of those. There might be others, but one that I can think of. And that's still in place, so I'm not going to say which one it was. Most of them are roughly planar features, shear zones or whatever, or porphyry pulses that are, one angle or another. And it's reasonable to mine that area and not mine the barren areas. Every once in a while, you get all this broken up stuff where the reality just, you're going to take everything, have to deal. It's not a strip ratio anymore. It's a lower grade. But the geometry matters here. Let's say you have most of these are planar features. If they happen to be angled sort of like at pit type angles, roughly 45 degrees, plus or minus, right? Then that's pretty good because you can lay your pit back and this mineralization will be nicely along one side of the pit and you just stop. You stop at the mineralization, that's the edge of your pit. The rest of this is waste. You just move it aside, it's fine. If it's vertical, though, vertical is great for narrow underground mining, but for pits, it's bad because you've got strip on both sides, right? You've got waste on both sides. And the deeper, even if you have consistent mineralization, goes down 1 kilometer, an open pit that goes down 1 kilometer for this narrow pit in the middle, I mean, the strip is going to be huge. You'll end up with 20 to 1, you're moving 20 tons of waste for every ounce of ore as you get deeper into this pit. So I'm doing a lot of arm waving here, but the point is it's the way to think about this is think of, in this context, this location, altitude, cost profile, what grade do I need to make money? And then that you can simply inversely relate to the strip ratio.
Yep.
If right. So that the higher the strip, the higher the grade needs to be. Right. If it's 10 to 1, then I need 10 grams per ton to be equal to that 1 gram per ton ideal.
Right. And so the formula here is also rather simple because even I can understand it. It's you take the grade and you multiply it by 1 divided by the strip. So if the strip is 4, 1 divided by 4 is 0.25, so you multiply by 0.25, and if they tell you, hey, we're making money at 1 gram a ton, but the strip is 4, well, actually you only have 0.25 grams per ton, so you're not making money.
Right. So yeah, that's exactly right. So if you think okay, I'm a gold bull, so I think that even half a gram per ton is going to be mineable in an open pit mining scenario. But then if you do the strip ratio calculation, it works out to 0.25 or less or something. That's pretty low grade. Like, would you invest in a 0.25 gram per ton deposit? If the answer is no, then that strip ratio just killed the speculation for you.
Mm-hmm. And the rule of thumb, as far as I understand it, but you tell me if that rule of thumb even makes sense, is that when you're looking at an open pit scenario, what you want is it depends on so many things, but sort of the minimum is $50 worth of metals in it. And so that would be your 1 gram at the current gold price. That'd be 1 gram of gold equivalent. And then
No,
undergrounds. Yeah, go ahead.
no, sorry, not I don't use a dollar like per ton metric because mining costs are highly variable.
Mm.
There are places, it's flat, there's infrastructure, there's hydropower, there's whatever, lots of production advantages that can make your mining cost per ton vastly lower than, say, somewhere high in the Peruvian Andes. It's 5,000 meters. Your generators can barely breathe, let alone the humans, right? Everything is more expensive. Um, so there's no one size fits all dollar. There's no standard or gold standard of dollars per ton.
So what I was gonna say here is that it's the 3M approach that matters. So MMM, margin matters most, and so you want to care about what are the mining costs per ton and how much value do you have per ton of
Yes, but this is starting to get more. I mean, yes, and that's why we look at feasibility studies and we try to
yeah.
find credible ones. Blah blah blah. We get into that, but we're trying to provide. If there's a simple rule of thumb here for people looking at strip ratio, if the answer is read the feasibility study, that's not a simple rule of thumb, right? So I think of it not as mining per ton, but I think of it as grade. If whatever I think is a minimum grade for an open pit project of its type, then I want to do that calculation that we talked about, and I want to be sure that the strip ratio still leaves me with that minimum grade that I'm looking for.
Okay. So far, and there's one more thing that I want to talk about before we move on to the PEA, but so far we've talked about grade variability, thickness variability, strip ratios, and therefore dilution, or dilution here, not shear dilution, although that's going to happen too. And we spoke about continuity too. Those are sort of the three more important things that I've written down here. But is there something that could be too expensive at this stage? Because value, I mean, you want to make money so what is too high of a market cap or something like that?
No, not market cap. The capex. All right, different ways to look at it. There are other expense factors. Like we haven't talked about metallurgy.
Yeah.
Right? What's your recovery? If you have a gram per 50% recoveries, that half a gram really is a way of looking at it. Or if you have a half a gram F ratio, but you're only getting half of it, well, that's 0.25. Anymore, right? So metallurgy is key. Capex is good. Metallurgy is complicated, but one of the sort of simple, again, rules of thumb, or boil it down, or an idea that the audience should keep in mind is if you throw enough pressure, heat, and acid in various combinations at any rock, you can get any metal out of it. So when you see initial tests, particularly bottle roll tests, which are the very earliest stage, they say, 92% recovery or 96% recovery or initial testing, blah, blah, blah. Take those now with a grain of salt, but like a bucket of salt. Because again, if you throw enough heat, pressure, or acid, or all three at any rock, you'll get everything out of it. But what's the cost? If you have to heat it to 1,000 degrees Celsius in a 5 atmosphere super kiln or something, like, you're never going to produce that. It would cost so much. It wouldn't be worth it. So we can get lost in the details, but just remember, be cautious of early metallurgy. All the early tests really tell you is it's even possible. Like, we can get this out of the rock, and then you need to look for reports, and this boring engineering stuff in the next phase is actually quite crucial in terms of how expensive is this likely to be. And a whole conversation about metallurgy is probably more than we want to get into now. But just keep in mind that you want good metallurgy, and the more advanced the study with good metallurgical results, the better. There's other things too, like hydrology. Is the rock highly porous? Is it below the water table, the deposit? Because if you're going to have to spend more money pumping water than mining, that can kill your project.
Yeah.
If your pit wants to be a lake, it really wants to be a lake, that's bad. There's a lot that can go into this, but a pit that wants to be a lake is fairly rare, and depending on where you are. If you're in a swamp somewhere, that's a real consideration. If it's a swamp in Quebec, they're frozen half the year or more. So there's ways of dealing with this. All of these are cost factors.
The Athabasca Basin entered the chat.
Yes. So if you're not confident that you have a grip for the kind of deposit or project this is and what the key variables are, then wait for the feasibility study.
Right. And that's what we're going to move into right now. So again, variability, strip, continuity, recovery. That's the bare minimum that you want to check when you're looking at these things. So there's 4 things that are very important. So I appreciate you going in depth on them with me here. What I was talking about was expensive, as in not expensive, just highly priced, because that's not always the same thing. But for me as an investor, when I'm looking at a company pre-MRE and it's already costing $1 billion, is that too much?
Yes.
Or is it the geologist's answer, which is, it always depends. It depends.
No,
but does it depend?
I'm with you on. I think you're absolutely right. And in the My Take service that we have, there are a number of companies right now where brilliant discovery. I'm not saying the deposit isn't real, or I'm not even saying it doesn't look economic. Like, this looks like a mine in the making. But if the market's already giving the company $1 billion or $2 billion in valuation for a project that doesn't even have a resource estimate, let alone a preliminary calculation of net present value, there's no way to know. Like, say it's obviously multi-million ounces of high-grade gold. Fine. Doesn't mean it's worth billions of dollars. It could be full of arsenic, mercury, or other nasties that will make it much more expensive or to process and deal with. Or it could have some of these other issues, water, or the competency of the rock could be a problem. There are a lot of things that come up that you don't know until you do that feasibility study. All that boring engineering work that nobody cares about, that produces the orphaned stage of the Lassonde Curve. That's really important to answering the value question. So if a company is being rewarded in advance for unknown value, that is categorically a reason for me not to invest. Now, other people will go there, but for me, I never buy that. Like, it's just an absolute rule it out scenario. How can I pay $2 billion for something that I don't know? I mean, let's say it's worth $1 billion in net present value. That's a great mine. But if the market's already giving it $2 billion, I'm asking for a 50% haircut.
And that's a relative way of looking at things. What I'm mostly thinking about is sort of the absolute. For me, it almost feels like if it's $1 billion at this stage, I don't even care. I feel like there's 2,000 other companies out there.
Yes.
That I could look into. So I almost just don't care anymore if it's $1 billion and it's pre-MRE. And that's probably wrong. So I'm waiting for you to tell me how.
I would say that the odds are that you're right, actually. It would take an extraordinary deposit to be, to not be the greater fool. To buy high and hope to sell higher is not the formula. We are looking to buy low, sell high. So when there are plenty of opportunities to buy low, hopefully to sell high, why do I want to take a chance on buying high to sell higher? Now, if you had some really extraordinary discovery, I'm trying to think of one off the top, and even the ones that look extraordinary, they often do turn out to be disappointing. You mentioned Great Bear, that's taken over. I mean, it looked really good. I think that's a mine in the making. I'm not throwing it under the bus. But again, the average was clearly much lower grade headlines. And that's what turned out to be the case in the end. So could it eventually be worth some billions more than what the company sold for? Probably. I don't think the buyers are necessarily stupid there, but it's going to take a lot of time and money and development, and the initial mine plan may not even be that. So, or Eleonore that I gave as an example before, that the mine they built isn't even the end of the deposit. So over the years or decades ahead, they could define more resources and mine them, and it could end up being many times. It was so this was like 15 years ago, and it sold for $750 million. And so in today's dollars, that's well over $1 billion. And in the end, it may end up producing several $1 billion for its current owners. That but these examples are really, really rare. There are a couple $1 billion juniors right now that it's really hard for me to see. I can see eventual value exceeding that, years down the road, but it's hard for me to see. And I'm saying gold being equal here. Like if gold goes from $2,000 to $5,000, then sure, everybody's valuation goes up. But that's not the point.
Mm-hmm.
We're talking about this company versus that company. If the rising tide lifts all ships, you're still the goal is to pick the ones that are going to rise the most, not just be in the average. I mean, or if you're going to do that, you can just buy an ETF. Sorry, just to wrap this up, the answer to your question is it's possible that you could find something that looks so good, so compelling, that even though it's like as an absolute number, I would not put $1 billion as a cap. Like I would never say I'm never going to buy a junior that's worth more than $1 billion, because it's possible that you could have something that that discovery really looks like it's worth multi-billion dollars.
Mm-hmm.
And the market's discounting that. So it's possible, but very rare.
And the quality of the thesis here matters too. And that's also when asking questions comes in handy again, because if you ask them, hey, this is clearly, priced way above anything else in the market right now, why? And if they tell you, well, Great Bear sold for $2 billion and that's the whole thesis, you might start,
right. Yes.
Wondering.
And so that's when, other people have done, it's not an answer, or is not an answer. Oh, well, we're right next to Great Bear, or we're right next to whatever. That's not an answer. Or gold's going up. I just, I not interviewed, but I did those exhibit hall tours that they do at the New Orleans conference, where some guru goes around and takes a gaggle of ducklings behind him or her to ask questions of the exhibitors. It's their way of driving traffic to the exhibitors halls to get those companies happy for having paid for their booth. But I like doing it because I get to ask obnoxious questions. And there's this one copper story, and I won't name it, but I was like, okay, there's there's a lot of copper stories out there. Why should we buy yours? Go. And the guy said, oh, because copper is going to $20 a pound. Well, in the first place, that was a somewhat optimistic projection. In the second place, it's not a reason to buy his stock.
Mm-hmm.
If I think copper is going to $20 a pound, I'm buying Rio Tinto or BHP or Freeport or something. I don't know. I mean, that would be a no-brainer.
Mm-hmm.
That's not company specific. There has to be the USP, the unique selling point, and it has to be credible for this company. Why your company?
Right. This is also where it sort of comes in. You mentioned something that you sort of glanced over, but it was important that if you think copper is going to $20, you might as well just buy Rio Tinto or BHP, because they're much further up the risk spectrum. I mean, that they're much more de-risked, and this is where it comes in that MRE.
But they're also go-to names, but I was shooting from the hip there. Actually, both Rio Tinto and BHP are broad mining companies. So if it was copper specifically, I probably wouldn't buy those two. I mean, they have exposure to copper, but Freeport would be much more copper focused.
Good point. Yeah. But what I was getting to is that it really depends where the company is in its stage. And we're talking about this part of the Lassonde curve, but this part of the Lassonde curve then gets broken down into MRE, then PEA, then PFS, and then DFS. And the way I sort of remembered those risk levels is that the MRE is what the deposit might be, the PEA is what the deposit could be, the PFS is what the deposit should be. And the DFS is what the
I
deposit.
hear you, but okay, the MRE is what the deposit might be. I agree with that. The studies, I would say, is they're answering the question what it's worth. Like
Okay.
they don't change the MRE. I mean, if you continue drilling and you make it bigger or better or whatever, then you're changing what it is. But if the resource stays the same, you don't change what it might be. What you're changing is, or what you're looking at and trying to progressively answer more precisely is what's it worth.
Well, yeah, what it could be in
What it
terms of
could
what
be
it could be
worth.
in terms of money, yeah. So what it could be
Yeah.
worth. And then the DFS is what it would be worth if you get the financing to build it. But there's no study that says what
okay.
it
Well, let's
will
talk
be.
about those studies. I like your idea. I'm not trying to
It's not my
do it. I
idea, by the
like
way.
the
I wish
idea.
it
It's a
was.
nice progression. Well, but it's one of those things. It's an intellectual framework that reality is a little bit more complicated. Um, so I like the Australian term for a PEA, the scoping study. It's really not a real study in a way. It's the idea. It's like conceptually, if we were going to mine this, how would we do it, and what might it be worth? So your word "might" is good there, right? It doesn't use very specific like cost specific to that company. You might use an average mining cost across the industry or energy costs, whatever. You don't have specific inputs. It's more like, okay, if it's going to be an open pit, these dimensions, assuming industry average cost, blah, 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 this is what it might be worth. When you start getting to the PFS, you start looking much more specifically. And some people will do more work at the PFS level. Some people will do less. I tend to push back against the D in what you call DFS, definitive feasibility study. There's no such thing. Even, some people call it a full feasibility study. People call it bankable. There's no industry standard. Okay. There's no, UN definition or government or even mining industry definition of this is the correct word. So I always just call them feasibility studies, because whether it's a D or a B or an F, they're just a study. And all these other words attached to them try to make them sound better than they really are. Full feasibility, bankable feasibility study, definitive feasibility study. It's still just a study. It's a study. It's still an estimate. Even if you have so-called proven mine reserves, it's still an estimate. You never know how a mine is going to be until you build it, flip the switch, and see what comes out of the plant. And even then, it's a moving target. So a full bankable definitive feasibility study is still a glorified guess with a phone book size heap of math backing it up, but it's still a guess. It's an estimate. And never forget that. It may be bankable in the sense that a bank will lend you money if they believe it, but that doesn't mean it's actually true. And even the very best in the business, it's not just fly-by-night juniors pulling a fast one. That we've talked about several times was built by Goldcorp. It wasn't a bunch of nothing nobodies. It was a large, successful company. They built the mine. And when they got underground, the geometry turned out to be different than what was thought in the resource estimate, which threw the whole study off. And all the costs and everything went out the window. Now, fortunately, the gold was still there. It was more complicated, and they had to adjust the mine plan, and they made money. But you're not always so lucky. Even with a full bankable definitive feasibility study, Antonio. So don't put too much weight on these words. But still, the takeaway here is that the PEA, the preliminary one, it's really just an idea. What could this be like? When you start moving into the pre-feasibility study, there's a lot of work to go into the full definitive bankable one. So it makes sense to have a stage in between, the pre one. And it's a pretty good thing. You're starting to look at specific costs. It's not just scoping. It's not just conceptual. It's this mine. What would this mine be like? But you don't necessarily have all the detailed answers to publish, a full study. It's still worth doing, because if you go, here's the thing, key takeaway. When you go from PEA to PFS to FS, your NPV and IRR usually goes down. Or sometimes there's a trade-off where we'll optimize for something, and they usually choose to focus on NPV. They want the value to be as high as possible. But that often throws the IRR under the bus. To get your NPV up, you might have to greatly increase the CapEx, and you could do it, right? You get more equipment, more expensive equipment, bigger equipment. You can mine more stuff. You can leave less in the ground. You can increase the value. But the return on that greater invested capital up front, it's going to take longer and it's going to be lower. So generally speaking, the numbers in the PEA are the rosiest. And when you get into the pre-fees and you get those PFS numbers, they're more realistic, but they're still preliminary. They're not going to be highly accurate. And when you get more accurate cost figures, they're almost always lower. And then when you have their final feasibility study, you have, and again, I'm not saying these are lies. I'm not saying it's bullshit. I'm just saying it's still a study. And so you have the most accurate study possible. That really is as good as it gets. I mean, you can't know more until you actually build it and see what Mother Nature did underground. So that's fine, as long as you understand that it's an estimate and it's your best guess at that time. Again, the takeaway though is the numbers tend to get worse. The more you know it, the less you like it. So you need to start out with a very robust number early on so that it can still be reasonably robust and have a chance of moving forward when you get to that point of going to the bank, whose hearts are so warm, and you need to have a pretty robust return.
You're mentioning three things here. Maybe there's a couple of more to talk about, and definitely want to talk about those NPV, IRR, CapEx. Potentially, we should be talking about the LOM too and how much it matters. But just before we get that, do you have any hard and fast rules in terms of dealing with, like, when you see a PEA, you don't have something that says, like with the MRE, okay, it's time to sell or it's time to buy?
Right. Okay. I wouldn't call it hard and fast, but there are some rules of thumb here that I think are helpful. One would be if the CapEx is larger than the NPV, it's not necessarily fatal, but it's a red flag. You're going to spend more money than you're going to get from it net at the end. Generally that's not great. You want it to be worth more than you're spending to build it in the end. The IRR, generally speaking, needs to be above 15% to get financing. People just aren't going to fund a 10% IRR. It's positive. The company can say, hey, look, this has a positive rate of return. The banks are only paying you 4% right now or 5% with these high interest rates. So we can get you a 10% return on investment. That's not enough because there's so many risks: execution risk, political risk, technical risk, so many risks that, it really needs a minimum of 15%. And that is a minimum. A lot of companies will come out with a study of 16, 17, 18%, and the stock does nothing. It's viable technically, but it's not exciting. It's not robust. Anything above, in the mid 20s or better, that's good. 25 or better, that's a pretty positive outcome. Anything over 30, 35 is very robust. But actually, it can go too far the other direction. I mean, in theory, there's no high, the higher the return, the better, right? But if you start getting over 50% IRRs or 70% that you see in some cases, that becomes, if not a red flag, something to question. Like, why is this return so high? Can I believe these numbers? Basically, if it's too good to be true, it probably is. And when you see these really high IRR numbers, it's usually because of some CapEx consideration. It's a very small project. Small mom and pop mines, we're talking about things less than 50,000 ounces equivalent, in a year. They often boast very high IRRs because the capital initially is so small. But they often have, all the troubles that they run into of the bigger miners, or they have sustaining capital issues and so on. Their OpEx is terrible. We'd see. But so rule of thumb, again, 15% IRR is the minimum. 25 or better is good. 35% or better is very robust and looks, like a mine in the making. We talked about NPV. The other thing is payback period. If you see a high IRR, but the payback period is 4 years or more or something. Something's wrong. Something's not adding up there. If this thing has such a high return, why does it take so long to get paid back on your initial capital investment? Generally speaking, I like Rick Rule's rule of 2 years or less. And it's not just because Rick says it, it's because prices move. Who knows what's going to be happening in 10 years from now? We don't know. We got a 10-year mine life, that's great. But I want to be paid back on my initial investment. If I could get it back in a year, that'd be great. Like I'm a gold bull, right? I think gold's going higher. But if I could invest in a gold mine and get paid back within a year or two, I have very high confidence that the gold dollar exchange ratio will support that and I will get paid back. What happens in 10 years? Well, maybe gold goes to $50,000 an ounce, but maybe at that point, oil is $500 a barrel and everything is more expensive, right? So it doesn't help me. A quick payback is a thing of beauty. Anything longer than 2 years, anything longer than 3 years is, if not fatal, it's highly questionable. Anything longer than 4 years is probably, I'm just not going there.
Okay.
It's just too long. And one other thing about studies is how old is the study? Like, never mind looking forward to what the mine might be. The study itself, after the period of high inflation we've been, and I'm not talking about the CPI, I'm talking about project-specific inflation. I'm talking about oil prices going through the roof, steel prices, and manufacture, ball mills, all this stuff. The cost blowouts we've seen from mine builders over the last year or two have been spectacularly bad. I mean, just real blowups in CapEx. So if that's happened over just the last year, and you have a full bankable feasibility study from the year 2020, I mean, just throw it out the window. I mean, right. Those numbers are absolutely stale, let alone previous decades.
Do you ever, so that's when was the feasibility study done? Do you ever look at how was it done and by whom it was done?
Yes. I don't want to get sued, so I'm not going to say names, but there are a few qualified persons under National Instrument 43101 who have signed off on some feasibility studies or resource estimates that I thought were highly questionable, and in some cases were forced to be retracted by the regulators. You can do this due diligence yourself, make your own little blacklist. Go and Google resource estimates and studies that the exchanges have forced retractions of, and make a list of the engineers who signed off on those studies and remember them. So I do look at that. What was the other part of the question? There was something else.
That answers it, because it was how it was done. But I don't know
how it was done.
Yeah.
So yeah, look at the other thing is to look at price assumptions. If the price assumptions are overly generous, or if they're near spot prices, forget it. Right? Yeah.
Unless it's uranium.
Unless it's uranium. Well, maybe, because the spot price is just now getting to the necessary incentive price. Maybe. But still, a project big enough to matter has, years of mine life. And even if you're a bull on the commodity, remember that costs will catch up as well. So if something is crap at $50 uranium, it might look better on paper at $80 uranium, but it's still a crappy project. If you have projects that are great at $50 uranium, why would I buy one that's crap at $50 uranium when I can buy one that's great at $50 uranium? It'll do even better at $80 uranium. And okay, uranium's $80, and the crappy one might survive or be okay now, but my costs will eventually catch up. And so a year from now, the one that was great at 50 will still be great, but the one that was only great because of 80 is now crap again. So I'm sorry to be very technical here, but the technical message is that crap is always crap. And maybe sometimes you can spray it so it doesn't smell so bad briefly with high prices, but crap is always crap. Just don't forget that.
What do you call those, land banks or optionality plays?
Well, land banks are not necessarily crap. Or let's put it this way. I'm sorry to go too far with this metaphor, but let's say that manure can be useful to a farmer, spread it over the field, it could do some good, right? Maybe there's some value in high quality manure. the track record for land banks is that when prices move, the land banks move, the share price move. You can make money on a land bank, but you make money when the price is moving of the underlying metal or mineral. You don't make money because those land banks suddenly become profitable projects and they get built and they become mines. That's not the idea. The idea of a land bank is you spend no money, but it's a bank that they're banked in the ground where nobody can steal those ounces or pounds. You leave them in the ground, you spend nothing on the company, and you get leverage to the upside when the metals price move or the mineral price moves, and then you take profits. And the problem with this model is that the management, they almost invariably fall off the bandwagon. They get all excited, and then they start wanting to play with big yellow trucks. Oh, we're going to build it now. Oh, uranium's $80. We're going to build our crappy land bank that didn't work at 50, right? And it seems to almost always be a recipe for disaster. I can think of examples where, in previous exciting times of high metal prices, a land bank fell off the bandwagon, decided to build the mine, did the full feasibility study, and they're still looking for financing. The smart money knows that crap is crap.
Just sort of to make it clear here is that a land bank, as far as I understand it, correct me if I'm wrong, is that it's a project that is unprofitable at the spot price of the given metal, but could be profitable at a higher price, and therefore, if the spot price of the metal would go up, the value technically of that project would go up by an unlimited percentage, basically, because it goes from negative to positive value. So that's
I mean, it's roughly accurate. I would say that the value actually doesn't change. That my view is that crap is crap.
Yeah.
So if the value is crap, it's still crap. So the value doesn't change, but the price can change because markets are not efficient and they're frequently irrational. Markets get oversold, they get overbought. If the central idea of the land bank is if you have bought, you have these known uneconomic deposits as you specified, and therefore they're on sale cheap. So you can buy uranium for, $1 a pound in the ground or 50 cents a pound in the ground when uranium is unloved and unwanted because it's not economic. No, this project has no chance. So you can get it just dirt cheap. And then uranium goes from $18 a pound to $81 a pound. This just happened, right? So suddenly all those pounds in the ground, it's kind of a bit of a greater fool theory, or maybe it's a hopeful fool theory. I'm not sure exactly what the nicest way to put this is, but I still think crap is crap. But you have all this giant resource. It's like, wow, they have 100 million pounds of uranium and the stock will go. Now, I would say that it shouldn't go. Crap is crap, but it does. And that's just a fact. This is a documentable trend in the marketplace. Land banks, when the commodity prices move, land banks move, and you can make money on that. And the number one takeaway, though, is you're looking at that delta in commodities price. And if the land bank has done its job, not blown its brains out and diluted its shareholders, spending money trying to advance and build their projects, they've just held them in the ground the way they're supposed to, then the alpha on that move can be spectacular. But beware of land bank companies falling off the bandwagon, and then beware of after the price move. At $81 a pound of uranium, right? It gave back 50 cents yesterday, I think. But anyway, up here over 80, the temptation for crappy companies or companies with crappy projects to try to put them into production now that they work is going to be huge. That brings an enormous amount of risk. This is the time to take profits on land banks along these lines.
But so if you're a gambling man, I suppose there's nothing wrong as long as you know that you're handling crap and you should be wearing gloves and just always make sure to get rid of it before it starts thinking, right? That's sort of the message here.
I think we can leave the metaphor now.
It's a great metaphor. No, I want to keep it. But okay, no, just so to recap, because we're in the PEA here. 5 things: NPV, IRR, CapEx, LOM, payback. And so to go from the last one, payback, you want it to be under 2 years. LOM, ideally, you want it to be over 10 years. internal rate of return, you want it to be over 15%. Too high could also be challenging because that possibly means that the mine is too small to matter. We talked about, go big or go home. And then when it comes down to the NPV and the CapEx, we talked about, again, a ratio. So a relative valuation here would be that ideally you want an NPV to CapEx ratio of over 1, which means that the value of the thing that is going to be mined is higher than the CapEx, unless, of course, there's upside potential. But we talked about that earlier on, district scale potential and so on and so forth. But there's also, by the way, another ratio that I make here, and that's also a question that I wanted to ask, is that I also look at the CapEx versus market cap and then start asking questions like, how are you going to finance this thing? Because if CapEx is, $2 billion and a company has a market cap that's like 200 million or something, if they don't have a clear answer as to how they're going to finance it, could be a deal breaker. But and the question here is, are there absolute values that you look for? Like if the CapEx is 2 billion, you're not touching
these absolute
I
numbers.
do. I absolutely do.
No, sorry, the world is relative. I remember as a physics major really being disappointed. Actually, before I studied at university as a high school student who was fascinated with physics, I remember discovering as a shock that I thought physics dealt with like the absolute bedrock of the universe, black and white, facts, true or false,
Yeah.
But it's all statistics. Even an atom, you don't know the location of the electrons or the protons, the neutrons is a statistical average for where they might be. There's a cloud. There's an electron cloud, not an electron location. And the whole universe is even fuzzier after that. Sorry, I digress. So no, absolute metrics are really hard to come by. But let's come back to the CapEx. For the obvious and easy one is NPV. There's risk in any speculation in the resource sector. So I want to discount to NPV at the bare minimum. Even if they say, oh, we have district potential, we have unexplored, undrilled, blah, 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 whatever. If there's a study with an NPV and the market is valuing the company on either an MCAP basis or an EV basis, if they're already being given the full NPV, that's too much. If there's no discount, why do I want to buy this? It would take a truly exceptional, like I'd have to really believe in the blue sky or right. And that's rare. So you want an NPV discount, and the higher the risk, if it's an Ebola central, I want pennies on the dollar on the NPV. If it's, a great mining jurisdiction, maybe 50% or 30% of NPV would be enough to entice me. But anything approaching NPV is just too much.
Well, so no, go ahead.
Okay, so CapEx ratio, that's not one. I mean, you're putting your finger on something that's real and true, and financing a project is an issue. But I get tired of that question. You see that a lot. Oh, how are you going to pay for building that? And the ultimate answer, and I'll actually take management's side on this, is if the margin is good enough, that's not a question. I mean, if this is a rich mine, even if it's not the biggest one in the world, maybe it's not totally world-class, but if it's rich enough, it will get built. And I can now say that I have seen this over the 2 decades of my career. I have seen this. This is an easily answerable question. The answer is margin, or IRR, if you want to look at it that way. If it's rich enough, it'll get built. And even if the CapEx is big, well, what happens then is you usually get taken over. If you've got a multi-billion-dollar mine and you're just a piddly junior, a $100 million market cap, well, if the project is that rich, you're not going to last. You're going to get taken over. If somehow the market has misunderstood the value in this, and you're still selling for 100 million, and you got a multi-billion-dollar project, and the numbers are credible, it's real or realistic at least, then you get taken over.
That's right.
And if not, then you do get rewarded. How are you going to build it? The other answer is if you don't get taken over, the market sees it. They say, this is a mine in the making. Investors, smart money piles in, and your market cap goes up. Your share price goes up, your market cap goes up. Now suddenly you're a $500 million company, or $250 million, or you're $1 billion company. And it's not so unreasonable for a bank to lend you the $1 billion you need to build your mine.
That's right. Yeah. So we revert back to the 3M strategy that I told you about, the margin matters most type of rule. It's again not my rule, but it's a good rule. I have I actually have two books here that I was just reminded of, and then so it's by Richard Feynman because you were talking about physics, and it's six easy pieces and six not so easy pieces. So if you could write this for exploration stocks, I would very much appreciate it.
It's on my to-do list, Antonio, in my copious spare time. That's not a joke, actually. Writing a how-to book for this space, there really isn't one that I know of.
Hmm. But
Not
they have
not
to be absolute things. So that's what I was talking about. Not nothing relative, because this is
well, I can promise that if I get around to writing it, it will be absolutely my best effort to be honest and tell people what they need to know rather than to try to sell them moose pasture somewhere. Like, I can
yeah.
absolutely promise that.
So why would you want to pay more than one time MPV? Is because it has district scale potential. It's
No,
underexplored and
no,
it's open in all
not potential.
directions.
If I could say pay more than one times NPV if, let's say it's a VMS, right? And VMSs are famous for coming in clusters, right? And let's say the NPV is on the first of 6 known lenses, not potential, not district potential, not 100,000 hectares of moose pasture, right? You have 6 identified lenses with drill holes in at least 4 or 5 of them, let's say, but the first one is well studied.
Hmm.
Something like that would be credible to me.
Right.
Like, okay, like, it's obvious there's going to be more here. Yeah, I can think of some examples, but they're still in place, so I'm not going to tell them.
Okay. Fair enough. You were talking about nasties earlier, arsenic, mercury. There's a bunch of other nasties. Not all companies assay for those. Well, obviously they don't want to advertise it, so you got to go looking for it, but you have to know what it is. Is there a point in one of those, in some of those studies, that they absolutely have to tell you about the nasties, and how do
Well,
you
you can
find out?
tell early on, they may not tell you what our arsenic content is, but when they're describing the geology, they pretty much have to say, they have to describe the mineralization. Even your initial 43101 report, even pre-resource estimate, if you just have a project description 43101, it will tell you what the mineral suite is. And if it has arsenopyrite in there, or if it has mercury in there, it'll be in there. They may not highlight it, but it'll be in the 43101. And certainly when you get to the processing, even in a preliminary study, then they'll have to talk about how they deal with any smelter penalties, which would relate to nasties removing them, or they may have a pox kiln in there, or I don't know, some way of dealing with it. And sometimes I don't want to discourage people and say, oh, only an expert can deal with this problem. But there are a lot of details here. So it's not like you just run the other way every time you see the word arsenic. Sometimes the gold is in the arsenopyrite. Like, there is no getting around that. It's with the arsenic. But if it's rich enough, you pay the smelter and you can deal with that. Sometimes it's not. Sometimes there's arsenopyrite there, but the gold is in pyrite, or it's free gold, and you can actually selectively float the arseno off and put it back in the hole in the ground where you got it, or something like that. So it's not a case where you just have this blanket. Okay, let me put it this way. If you don't know what you're doing, if you haven't studied this enough to try to sort this out, whether it's a problem or not, then probably yes. You see arsenic, just don't go there.
Right.
But be aware that there are ways of dealing with these things. And if it's either rich enough, or if the mineral suite is advantageous enough, there can actually be low-cost ways of dealing with nasties, depending on the specific geology and geochemistry of the project.
Right. Is it a viable question to ask the company if they're assaying for it, and if they have it, and just ask around, like, talk to me about arsenic and mercury?
Yes. Sure. I mean, there's no such thing as a bad question or as a stupid question. Only the unasked question perhaps is bad. But it's absolutely fair game to ask them. And let's say they don't have any, right? You can just say, oh, do you have any, potential penalties in your mineralization? I don't know. And they can say no, or yes, or we don't know. We'll have to check. If they say we don't know, that's a red flag.
Sorry.
If they say no, it's pretty rare that somebody will just flat out lie to your face. It has happened to me once or twice in my career, maybe a few more times, but it's rare. I mean, usually they rely on obscurity to hide whatever deficiencies they have in their project. To actually get in an investor's face and say it's X when it's Y, that's pretty rare. They count on people not asking or not knowing enough to ask the hard questions. So it's perfectly fair to ask them, and it's reasonable. If you ask the hard question and you feel that the answer is straight up, they're not trying to dodge it. That it's usually reasonable to think that's fairly decent information you're getting.
I tend to go a little bit overboard with this question because I would start by asking about arsenic and mercury because they're the most obvious ones. And then I change up the question, but it's the same question asking, okay, what about other deleterious elements? So I throw in that word. It's kind of hard to pronounce for me, but I still try. And then I ask a third question, which is, okay, what about other penalty materials that you might have with a smelter? Because those can be the same thing. So an arsenic is, well, it's arsenic and it's deleterious and it could be a penalty material, but they're not always the same thing. So sometimes you could have a material that's not deleterious, but it could be seen as a penalty.
Right. If it's low grade enough, it complicates the recovery and it's a cost. But if there's enough grade there, there's a fair amount of gold deposits that have antimony in them, or antimony, depending on how you want to pronounce it and what continent you come from. And by the way, it's deleterious. More syllables than that. But anyway, low grade antimony can be a problem. High grade antimony can be a credit. So one size doesn't fit all. But dear audience, if you're even asking these questions, you're already 80-20 rule way ahead of the investment herd. So don't be discouraged. We're not going to finish the Lassonde curve. We're an hour and a half into this, and we're still in the boring engineering phase.
Yeah. No, we're not. I mean,
we're gonna have to do a part 3.
Definitely. And if there's a part 3, 4, 5, or whatever, we might also have to eventually talk about separation methods, and that's where we can get into metallurgy, because you have a good piece on that. What's the piece called again, so people can look it up?
Oh, it's probably one of my cheat sheets. The cheat sheet on processing.
Cheat sheet on processing. I think I read it, and I like how everything is structured, by the way, on independentspeculator.com in the free articles, because when you're reading a free article, there's links to other stuff that I know why they're designed, which is good. But it's also, there are links to free stuff that you can read to read more further into that subject. So the cheat sheet on processing, that's also something that we could definitely do a conversation on. But again, maybe too much of a topic for one video. So we were at the PEA. That's basically it. I mean, it's not it, but it's definitely a good start to the PEA. Does anything change when you're looking into the PFS and the I'm not going to say DFS, the other one?
The feasibility. Well, sure. I mean, you have more and more accurate understanding of the potential of the project. You never have full knowledge. Again, to quote Monty Python, it's only a model, right? At the end of the day, it's still only a model, but it's a better and better model. So I'm not completely dismissing it. You have to understand that there's always risk because it's only a model. So from the speculator's point of view, I think that the takeaways or rules of thumb or key lessons from the boring engineering phase are that you do progress as the studies progress to greater understanding and greater reliance on the results of the studies. That's real. I'm not saying it's all BS. The return tends to get worse. The more you know the project, the lower the rate of return and tends to be, because you discover all the hidden difficulties and complications that you didn't know when you just assumed industry averages in your PEA. The well-documented phenomenon, the orphan phase here, when all this engineering work is going on, it sounds terrible, boring orphan phase, but actually this can be the foundation period for a great deal of value added for a disciplined, patient speculator. Because when you start getting these results, if the metallurgy, we talked about how bottle roll tests are just an initial phase. And let's say we're dealing with gold mineralization. They do bottle rolls and it comes out 99% solid, cyanide soluble. Great. Doesn't tell you anything about what would actually happen in the mining process. But if they do big column tests, at various degrees of crushing or grinding, and they run them for months and they simulate, these columns can be really big and simulate like a stack of ore on a leach pad, 10 meters tall or whatever, and you trickle cyanide at the top and you see how much gold comes out at the bottom. You do that for months or whatever it takes. So that's much closer to the actual field conditions that you're going to get. And you can even subject it to different temperatures or things. So there's a lot you can do with these tests. And the more you do, the more you understand what it would likely be like. And when companies put out metallurgical test results, share prices almost never move unless there's a sudden surprise to the downside. Like people know, like, oh, we thought it was 80% recovery in the PEA, and now we do, feasibility tests and it's only 60%. The stock will move down on that. Mm-hmm. But if they go from, oh, we thought it was 80%, and now we've done a more detailed study and it's 83%, the stock isn't going to move at all. But that 83% on the more detailed study, it's a much more important number. A lot more about this than the 80%, which was just based on assumptions. Like this is based on actual results. They trickled the cyanide over the rock and they measured how much gold came out the bottom. No, it's not perfect. It's not exactly the field conditions, but it's a whole lot better than assuming industry averages. So, I mean, you know more at this stage. And so if you're looking at the boring engineering phase results and looking at the geotechnical drilling and, what are you going to get out of geotechnical drilling? Unless it happens to bump into a new discovery, all you're going to get is, oh, the rock isn't bad. That's not going to make a stock move, but it's really important because if the rock is bad, that's a big problem. So again, you don't have to be a geological engineer, a mine engineer to write your own study while you read all these press releases, but you can look for fatal flaws and you can look for good results and you can start stringing these together as you work through the boring engineering phase. And this sets you up for maximum benefit from the pre-production sweet spot, which is, my favorite part of the Lassonde Curve to invest in. It's another free report on the website. Anybody wants, they can download the pre-production sweet spot report. And the point is that during this orphan phase where nobody cares, nobody wants to hear about metallurgy or hydrology or geotechnical drilling or whatever, you can start looking at the bits and pieces that will go into that feasibility study and the decision to build the mine, and you can get in front of it. Mm-hmm. And you can buy low. So don't neglect the orphan phase. Now you have to be patient. And you want to look at things like permittability. It's fine if the engineering is not so boring to you, but if you're in some place, it's an open pit in Mexico, say. Right now, the government has just said, we're not permitting any more open pits in Mexico. So it doesn't matter what they come up with in the engineering phase if you can't permit that project. Hopefully that will change with the next government. And, but you see what I'm saying? You can't just base it on the engineering results. All I'm saying, though, is that you're getting more and more, useful and detailed information about the potential of this project before you get up to the pre-production sweet spot. And then you can position yourself from maximum gains when you do have that construction decision.
And it's well, actually, you tell me if this is right or not. But most often than not, moving from PEA to the other feasibility studies, the numbers that we just went over, IRR, payback, LOM, they're gonna drop. I mean, they're gonna go in the disappointing direction. Yeah. So if you're just on the margin during the PEA saying, well, this might work, you might as well give up. Is that right?
Yes. I mean, there can always be an exception, but the odds are, if you're marginal to begin with, forget it. It's, just don't even go there.
Okay. That's a good point. Right. But there's nothing else that you would like. There isn't any new NPV type of ratio or something else that you would add just because the company moved from PEA to PFS, something else that you wowould look at, something new?
No, the studies look at the same numbers.
Okay.
No. I mean, I don't want to repeat myself, but I would look at the boring engineering results because that helps me decide, like, of all the people that get to that shovel ready phase, some of those will just never go anywhere. Mm-hmm. And in my job is to try to predict which companies will successfully enter and exit the pre-production sweet spot with a nice gain for my clients.
And so the PPSS is what Rick Roll said was the most important work you've ever done. So that is something that I just think that deserves its own episode, because so we've went through everything on the Lassonde curve. We're sort of at the second thought. I cannot say that word. We're at the second dip, and we're now moving into the PPSS. If you want to give a cliffhanger, sort of short overview where people can read more about that, we can do that now.
Sure. Well, as I said, it is a free download. If it's not visible on the homepage when you get there, you can type in the little search tool PPSS or click on the free report section. It's there. The title of the download page is called The Greatest Discovery of My Career, because of what Rick said. But the idea is, by the way, I didn't discover the pre-production sweet spot. It was called that before I came into the industry. But as far as I know, and this is my claim to fame in this space, is I'm the first one to quantify it. First one to do thorough research, finding, I don't know that we have them all, but if we don't have all, I think we have almost all of the examples of the last 30 years. So it's not just like a representative sample. We have 5% of the PPSS cases, and we think that's representative of the whole. I think we probably have 95% of them, or something like that. Since I don't know the number, I can't tell you what the percentage is. But we have looked for years, and we've been following this for years, and on an ongoing basis, we know them all. Like, since I started looking at this almost 10 years ago, I know all of the ones who are first-time mine builders and what the result of their action is. And the result is, overall, the average gain from a construction decision to first pour or first production of whatever type is around a double, around a 100% gain. And that's extraordinary. Not everybody succeeds at building their mine, but most do. Something like 95% of the companies that start out to build a mine succeed. And that kind of makes sense. I mean, the banks aren't going to lend you hundreds of millions of dollars or billions of dollars to build a mine if they don't think you can do it. So I'm not saying 95% of the cases yield 100% gain. It's not quite so pure and beautiful. Clearly, in a bear market, the gains are less. In a bull market, they're more. But even in a bear market, the average gain is still positive for a PPSS play, something like 25 or 30%. And some of them don't succeed, right? Some of them actually do fail, or an endangered mosquito is discovered on the property and they get shot down, or they get taken over before they can build the mine. And so if a larger company with multiple mines finishes building it, it no longer counts as a PPSS story. And that takeover may or may not give you the same benefit that a full ramp up to production would have done. So it's not, so we don't count those as success stories necessarily. But something like 70% of all the cases in the database have at least a positive outcome for investors. So that's the beauty of what I'm saying. I'm not saying it guarantees a win. And as we were just talking about the boring engineering phase, there's due diligence to do to try to position yourself for picking the very best PPSS stocks. But the odds of coming out ahead are good. I mean, they're better than 50, they're 70%, right, with just some kind of ahead of your initial investment. That's really good. I mean, we talk about resource speculating. We talk about how hard it is to pick good stocks here. Something that wins 70% of the time is extraordinary. And something that, if you pick the right ones, on average, yields about a double. I mean, okay, we all love 10 baggers or whatever, but those are hard to find. Nobody knows what's going to be a 10 bagger in advance. But if you have something that has a high probability of success and can yield a decent double or better, and in a bull market, the average is higher, right? So I love this. And, the problem with it is that there just aren't that many people building their first mine on a it's not like there's hundreds out there that we can pick from. Every year there's maybe 2 or 3. So there's not a lot. So you have to be patient, and it takes time to build a mine. On average, it takes 1.5 to 2 years for a junior to build a mine. A larger mine is obviously a bigger project. So it takes patience. There aren't many of them. You have to wait for payday. But the odds are that this is this is the best reward for risk that I have found in the entire resource sector. And it's hands down my favorite type of speculation.
There's a famous resource fund called the Commodity Discovery Fund. It sounds to me like you should start the Commodity PPSS Fund. But this is an interview in and of itself. I'm hoping for an hour and a half next time when we talk about this, because I just have too many questions. But yeah, again, it's independentspeculator.com that people can check that out. I don't think I have any other questions for this part of the Lassonde curve, but is there anything I'm missing here, Lobo?
No, I mean, apart from the PPSS idea itself, you do want to watch for fatal flaws. One of the things of beauty about the PPSS, or this ramp up to the end of the Lassonde curve, is that you never really know if the mine is going to work and deliver as advertised until the end. Right? You turn the mine on, you flip the switch, you shovel a bunch of dirt in the front, you see what comes out the back, and then you know whether those studies were accurate or not. That's at the end of the pre-production sweet spot. That's after you've hopefully already got your double, and at least taken profits, if not rotated out and into something else. So the highest probability of failure for a mine builder is after you've already had a shot at taking profits. That's what I love so much about this. So keep that in mind. That being said, there can be fatal flaws discovered along the way. If there are cost overruns, that's a red flag. If there are delays, that's a red flag. Delays always lead to cost overruns, by the way. There's no such thing as a delay that doesn't cost. I mean, at the very least, you have holding costs, right? You have all these people, you can't fire them, or you don't want to fire them because you may not get them back when you need to get back to building the mine or whatever. So delays are cost overruns, no matter what. And again, they might suddenly discover an endangered mosquito on the project, or the government could go klepto on you and decide, oh, you know what, we own 51% of your mine, take it or leave it. Things like that. So you can't just buy the stock at the beginning of the PPSS or position yourself during the boring engineering phase and then stick it in a drawer somewhere and forget about it until they reach first pour. You need to keep on it because bad stuff can happen even to good projects.
Fatal flaws sounds like a list of absolute things that we can make for next time.
Absolutely, my friend.